Welcome to Investment 360. In the hot seat this evening, Dr. Adrian Saville, CIO of Cannon Asset Managers. Adrian, it's always a pleasure to have you on the desk, and we're focusing this evening on a very interesting portfolio called superdogs. You're going to have to highlight the premise behind superdogs.
Superdogs is, I think, Cannon's purest view in terms of finding exceptionally attractively priced assets. So it embodies, in every sense, our deep value philosophy. And attached to that, we think that these assets overarchingly have exceptionally good prospect. So the dog analogy refers to companies that have become, neglected, overlooked, perhaps beaten up by industry circumstances. It certainly doesn't make any reference to the nature of the asset, but rather about investor sentiment.
So it's not an indictment on management to be in the superdog portfolio?
No, in fact, the glowing compliment is the super part, because the super is the allusion to, or the reference to, the fact that these are exceptionally, these are assets with exceptionally good prospects when sentiment is removed.
Adrian, before we get into some of the stocks that you might be holding, are there any stocks that you will not look at? I know that you have a preference for mid-cap stocks instead of the larger ones. And then will there be a case where perhaps the value part, the value indicators are saying this is a buy, but you'll decide not to because you think perhaps the outlook for the company just doesn't show how that value is going to be unlocked?
Well, let me try the different parts in lockstep. The first issue is, are there any parts of the market that we wouldn't look at? Absolutely. In the way in which we build this portfolio using a set of value factors, there are some places where these value factors do not work particularly well. In the experience I've had in building this portfolio over the last 15 odd years. The resource sector is a good example of that. Very young startup companies is another a good example. And then there are some specific rules that we put in place just to avoid replication of risk. So if we find two really attractive companies and one happens to be the holding company of the other, we would only take a position in one of those stocks. So there are some exceptions. And the portfolio, in looking for very attractively priced assets, there is the risk always that you're trying to catch a falling knife. And so we have a principle that we apply, and that is no investments are made in loss-making companies. So this is not a portfolio that's looking for turnaround stories or recovery assets or rescue operations. These are profitable businesses that are out of favor because of sentiment.
You mentioned that the study has been in play for some 15 years.
Yes.
Take me back to when it started and how you started it. And again, I've read a bit about the portfolio, and I want you to compare the dogs to the diamonds to the JSE, effectively the Indian and the FINI.
Sure. So because the portfolio is built out of only financial and industrial stocks, including property companies, to go to your earlier conversation, it's appropriate to reference the performance of this portfolio to the financial and industrial index rather than the broad market, which includes resources. And using the portfolio that we've been building since 1996, had you put 100 into the market in 1996, you would have 500 today.
So that being the FINI and the index?
Sorry, the market being the financial and industrial index. Your 100 would have grown to 500. You referred to the diamonds, and the diamonds are the loved companies. This is where sentiment is crowded around and very much in vogue, in favor, loved businesses at that juncture. And had you allocated capital to the diamond or the loved companies over the last 15 years, your 100 would have grown to 400, underperforming the index. Had you put your capital, your 100, into the superdogs portfolio, that would be 1,800 today. So you would have 4 times, 5 times, or 18 times your starting capital.
Kevin, an impressive track record?
Very impressive. Just looking at some of the stocks that are within that portfolio at the moment, I see that you've got a weighting to some construction stocks. Just your view there?
Well, this isn't a specific view on construction because we're including stocks across all parts of the market. So you'll see that there's exposure to retail, there's exposure to information technology, there's exposure to engineering, building and construction, and so on. The building and construction is a theme that I know we've spoken about it on the show before, but it's one that, leaving aside the superdogs portfolio just for a moment, at Canon we are optimistic about.
Even taking into account Stefanuti and stocks coming out yesterday with, what was it, 40% down at headline earnings per share, throwing forward to that result?
We think that all of that's in the price.
Which is why the share price didn't move.
Well, yeah, you know, the share price hasn't moved. You saw Group 5 come out with results that, against a blank canvas, were disappointing. But, you know, this was all in the price. Across Canon's house view portfolios, the building and construction exposure that we have is to companies where there is exceptional strength in balance sheet. I think this is going to be necessary for the environment, and it really equips these businesses to walk, I think, in a even fashion through a very, very difficult terrain. But the two that you refer to in the superdogs portfolio, Stefanuti and Basil Reed, well, you know, both of them we know are going to disappoint in terms of their earnings. Earnings are going to decline, but in each case there are exceptionally strong balance sheets, and when we made the investment into these two businesses, at the point of investment there was more than half of the company's market capitalization was represented by cash.
How big is your investment universe when it comes to superdogs?
It is a very broad universe, so notwithstanding the parts of the market that we exclude, loss-making companies, resource companies, and so on, there is nothing else that's excluded apart from liquidity constraints. So we wouldn't make an investment into a company that, you know, with liquidity it's easy to buy, it's very hard to sell. So we have liquidity constraints which will exclude exceptionally illiquid companies, but that doesn't preclude us from making investments into very small companies. In two cases in point, a business called Winhold, which is a very small packaging business by market cap, exceptionally attractive valuation metrics, and a stock ISA, which is a technology software business. And when we first invested in the company just over a year and a half ago, the stock was at 40 cents, very strong balance sheet, a dividend yield of 12%. And since then the share price has doubled, including another dividend of in the order of 10%. So it's been a fantastic return. The market cap of this business is 150 million, just over 150 million.
Kevin, you wanted to jump in there with a question.
And your time frame when you're making each individual investment, do you have an average time frame, and what was the time frame with the model as you were going back in order to see this value unlocked?
Kevin, the portfolio is built with a one-year horizon, so each stock is built under the assumption that you will see some form of reversion, and hopefully it's the healthy reversion, not the nasty reversion, but you'll see some form of reversion within a relatively near-term horizon. So 1 year is the construction period. Over the last 15 years, we found that the average holding period for these companies is about 2.5 years, which is, I think, a reasonably mature horizon, although a little shorter than our conventional holding times, which tends to be between 3 and 5 years at Canon. But I think it's a reasonable holding period.
Adrian, do you eat your own cooking? In other words, have you got money in superdogs?
Yeah,
am I allowed to ask fund managers that? Kevin, brace yourself, because I'm going to ask you exactly where you're putting all your money.
I guess that this is live television. You can ask me anything. Absolutely. I think that, you know, eating your own cooking is probably one of the best ways of testing, you know, the conviction about a portfolio. And my personal investments are exposed in two ways: to the Canon Equity Fund, which I run, and half of my investable asset is in the superdogs portfolio.
Has it caught your attention, Kevin?
I actually came across this a few months ago, and I was deeply intrigued. Adrian's
has he managed to hold your
competent.
attention on this?
He definitely has, and I think it's a fantastic idea, and I think the proof will be in the cooking.
What about timing? And let's talk about tranches here in terms of what you're expecting from, because this is a retail portfolio.
Yeah, what we're talking about here is a retail portfolio. It does have a reasonably high entry point relative to other fund offerings, and the minimum capital that we can take is 100,000. So that does make it, I suppose, less widely available. It brings some greater discipline in thinking about whether you want to be exposed to this. Our conviction our argument about how investors should be thinking about that is captured in that word investors. We want people to consider this not for 3 months or 6 months or a year, but this is an investment portfolio. So in my personal circumstance, the part of my balance sheet that I refer to as being invested in superdogs is actually there for my kids who are 8 and 5 years old. Long horizons.
Kevin, you had a final question for Adrian.
Just in your fact sheet, you outline what are the criteria that you look for buying. What are the criteria that you look for selling and unlocking that value? Do you look for a fair value on the stock or a premium to that?
No, the model citizen is a stock who moves from being in deep value territory to fairly priced, so it is no longer deep value, and that is because the price part of the equation has risen rather than the earnings part has collapsed. So that's the model citizen, as someone who has price reversion. And on review of the portfolio, which is done on a monthly basis in the construction, but on review of the portfolio, if the stock no longer satisfies those criteria of being deep value, it's removed. By convention, about 2/3 of stocks exit because they've achieved good returns, and it's a third that continue to disappoint.
Adrian, thanks very much for your time. Dr. Adrian Saville, CIO of Cannon Asset Managers.